Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's July 10th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. You know, there's so many different investment styles. Nowadays, most people separate them, or I would say simplify it into two categories, which is fundamental and technical, which I know most of you are familiar with. But investment styles, they go so much deeper than that. For example, you have large cap investing, investing just for income, investing for growth, top down, where you're looking at the macro picture, bottoms up, which is more about the company, less about the macro. You have your classic technical investing. You have momentum investing. You have buy and hold venture investing, angel investing, which is investing in early stage companies, investing collectibles, real estate investing, REITs, MLPs. With sector investing, you can go algo investing, hedging, trend investing, short selling investing, asymmetric investing, option investing, sentiment trading, overseas investing, emerging markets, ETFs, speculating investing, quants, crypto investing, value investing. You have deep value investing, right? Deep value, which is, I don't know, with the people who think they're really good value investors basically call themselves, we're not value, we're deep value. We're deep value investors. And I keep going on and on, about these investment strategies. But you can go anywhere. And my point is, all of these strategies work at one time or another, depending on market conditions. And some of them don't. I mean, there's not a strategy out there, as you guys know, that works 100% of the time. Renaissance may be pretty close to that. That's why they have, $160, $170 billion in there. But there's not really a strategy that works. There's zero strategies that work 100% of the time. Or say that something that could provide you with a 7% risk-free return. If you have something like that, good luck. Start your own fund. You'll have $100 billion. Go right into it right away. But imagine all those investment styles I just broke down. Imagine if you could become an expert on every single one of them. And you could definitely do it. Anyone could do it, right? It just takes time, dedication, hard work, willing to check your ego at the door, because most analysts I know, and good analysts, they all believe they're the best. And their style is superior to everyone else's. They're supposed to feel that way. That's fine. It's just like if you ask James Harden, Kawhi Leonard, Kevin Durant, LeBron James, who's the best player in the world, all of them are going to say, I'm the best player in the world. And sometimes that creates an ego where you do not want to change. Hey, this works. This is my style. That's it. But just imagine if you didn't have just one style of investing. You became an expert or became really knowledgeable on all these styles of investing. For example, we have a ton going on with trade right now. China, also India, Middle East tensions. Europe's the cheapest it's been in a long time. We've seen slower growth. We have low interest rates, going to remain low for a while, after what Powell's saying. So being an expert or having a deep understanding of a bunch of investment styles, you can determine what geography or country you want to invest in, which is the macro. Maybe you're a speculator or an angel investor. So, hey, you know what? In these countries, I'm interested in learning more about the small and micro cap names. You have a deep understanding of big cap companies. And a lot of those big cap companies, especially international, pay dividends, and that's income. You also understand that income is usually a factor of growth, right? In other words, if you want to generate income, make sure you're buying a stock with a solid yield, of course, but you have to make sure that it's also growing or has growth catalysts, or that 5% dividend is going to be pretty much meaningless when you're down 30% on the stock. A lot of people just look at the dividend and say, wow, this MLP is paying 6-7%. If you lose 20% of the stock, it's kind of meaningless. Got to look at the company. The company, in order for that dividend to be solid, it's the capital gains plus dividends that are going to give you that kind of income. You look at the volatility of the market you're investing in, and you could trade it using, algos or playing momentum on both the long and short side. You can use options to do that because remember, you're an expert in everything as well as options. Or you could say, hey, I'm a value guy. Go look at Japan, Greece, where looking to buy and hold long term. These are two markets that are cheap. And also, hey, they're starting to gain a little bit of momentum right now. Or you could look at these specific companies and say, hey, you know what? I'd rather invest in the debt of these companies and corporate bonds. But imagine having that sort of access. If you're knowing every investment style, being familiar with almost every publicly traded stock, knowing most of the major trends, and you're in these things because you have great context, but you're able to get these trends before they go mainstream and people are talking about them. You know when to be aggressive and you know when to retreat and be conservative. Because knowing all these investment styles, if you think about it, if you're knowing them and when to use them, it's going to basically allow you to find new ideas pretty much all of the time and in any market conditions. So you can go long or short, but you're always going to have opportunities. I know what you're thinking. It sounds crazy. How can we learn all these styles of investing? Hey, most of you listening to this right now, you have jobs. A lot of you have jobs outside the investment area, and you listen to me to, get the real story and no bullshit that you hear out there in the media all the time, and that's cool. But you guys do own your own businesses. Some of you, it's not easy finding the time to learn all of this because you also have families as well. Plus, if you commit to learning these investment styles and say, Frank, I want to be a smarter investor. I want to learn all this stuff. Where do you start? And how much money is it going to cost to gain access to this information? You can learn all of this by simply listening to this podcast and my interviews. I've interviewed Rich Sutmeyer, trading, talks about the macro, the smartest guy when it comes to analyze the Fed balance sheet, so balance sheet analysis for the Fed. And Mark Lichtenfeld on, who's an income specialist, Ken Fisher, portfolio manager, who I interviewed a while back, and they reached out to us. He wants to come back on the podcast, Ken Fisher on TV. He's familiar with my dad as well, back in the day. He's been around for a while. Mike Alkin introduced to short investing, options, Chris McIntosh, asymmetric investing. We have Marin Katusa, resource investing, Lou Bassani's technology. I interviewed Mohammed Al-Arian, which is, global economies. Chris Wood is a great small cap tech analyst. James Altucher is seed investing, venture investing. He's able to get into ideas. I know James well. Steve Sugarud, sentiment trading and ETFs. Dan Ferris, deep value. Jim Cramer, I've had on here, momentum, growth. I can keep going and going. We're talking about probably over 1,000 people that I've interviewed over the last 11, 12 years. That's how long I've been doing this. And how much does this cost you? It costs you nothing. You get all this for free through this podcast. And again, I've been doing this for a long time, interviewing the best analysts on Wall Street, and that's where my education comes from. I was able to learn so many different investment styles through these interviews. And it's important because, guys, as an investor, please listen to me here. As an investor, you always have to be willing to adapt to the markets. Take Dan Loeb, for example. Great hedge fund manager, billions in assets under management. Always figured him kind of like as a value guy, I would describe him. Large cap, macro investing. But he saw the writing on the wall. He knew interest rates are going to be low. We're in a growth environment. And even later on, with Trump getting elected, where tax reforms are coming. Inflation is low. So he knew growth is in favor. And you know what? He bought Google, Facebook, Alibaba. And he made a killing on those names. To me, that's great. That's a person taking advantage of what's being given to him. He's not fighting it. On the other side, you have a guy like David Einhorn. Also billions under management, which have been shrinking. But he's more of a deep value fund manager. He refused to adapt to the markets. No technology really in his portfolio, at least growth technology. But he got crushed buying value stocks. His performance has been terrible for over 5 years, where the markets have been in a super bull market over the same time frame, being led by those growth names like Netflix, Facebook, Microsoft, Amazon. I'm just using an example. I'm not picking on Einhorn, who I'm a fan of. I think he's brilliant. But you have to understand it's like buying resource companies in a cyclical declining market. If that's all you do, then you know what? You pretty much, excuse my language, you're going to be fucked for 6 years because that market's been out of favor. And it's starting to come back into favor now, which we all know. Gold and silver broke out. But imagine just doing that, just being a resource analyst, and that's all you do. What do you do? Because it doesn't matter about the companies. It's the macro environment. I mean, there's amazing companies traded, but all of the whole sector is down 60, 70, 80% still from their highs in late 2011, 2012. Doesn't matter what you pick, who the management team is, how big the deposit. It doesn't matter when the sector's out of favor. You can't say, wow, value, this guy's really good. It doesn't matter. It doesn't matter if the Pope's running that company. Nothing in that sector has done well. Again, it's starting to pick up. But imagine just, hey, I refuse to learn and I'm a resource analyst and that's what I write about. It's pretty crazy to think about it. And it's funny because people ask me all the time, why do I do this podcast? And it's funny because I hear this from our competitors and publishers in the industry, and they're like, Frank, you're insane, man. I mean, it's you're just providing too much free information. You're crazy for doing that. And I don't know anyone who's made money that, well, we're able to establish our own business, but through that podcast, because we have, fortunate to have a pretty good following. But as you can see, I have a front seat to the best analysts in the world. And after I interview them, they become great contacts, which help build my network into a powerful list of who's who in the industry. I mean, I don't really have my interviews set up for months in advance. It's usually 2-3 days ahead of time when I call these people because, I have a good contact list and these guys like to come on the show, give you guys information, say, hey, you got room to, okay, cool. I'd say 90% of the time the people I ask say yes. Because even if they're going away, they'll do it away. They if they're on a trip or in the field, if they're with their families, I'd rather they don't do it and just, you need that time with your families and stuff. But it definitely helps. I don't have to plan these interviews for, 3-4 months in advance. These people become great contacts. And most important, learning from these guys, it allow me to adapt to different styles of investing and take advantage of what the market is giving me. It's also fun because a close friend, described me to a bunch of his friends. He said, hey, this is Frank. He's a growth investor. It was about 9 months ago. Yeah, he focuses on growth. That's his specialty. I'm like, I don't focus on growth. I've just invested in growth over the past 6 years because that's the market. That's what's been giving me or giving us. I mean, I would actually think I'm more of a value investor. That's my background growing up with my dad, deep value. Before going to Kramer, who was totally the opposite. But, I didn't realize that kind of education I'm getting because you don't really learn those two different investment styles, momentum, growth, and then deep value. It's kind of like, pretty separate, right? It's two different things. Even though both investment styles, just two different things. Turned out to benefit me tremendously. I didn't know it at the time, but it did. Just gave me two educations. But value, it's out of favor. There's nothing you can do. Don't fight it. Don't say, wow, look how it's so cheap. And I don't care if they have growth catalysts or whatever, it's just so cheap. I'm going to buy it. And it's a growth market. And then you're David Einhorn, you're getting crushed. And when value does come back into favor, which, we're starting to see in uranium, and I mentioned earlier resource sectors, gold and silver, breaking out a little bit here. Then I'll adapt, allocate money to these deep value plays, recommend a lot of them in my newsletters. But, I'm going to take what the market gives me. So why am I telling you all this? What's the purpose of this? As an investor, you have to be open to change. You have to be open to new ideas, especially if you're older, if you're a male and you're stubborn. We become so stubborn, 50s, 60s, and, we're like, this is the way things are done, and we don't want to learn anything, and forget about that stupid mobile phone. Those things are stupid. You just don't be that way. Adapt, learn. It's so easy to learn about anything. You can go on Google. You can do all this stuff for free. But you have to be open to change. And it's the biggest flaw I see with professional investors who are just crazy stubborn. You have to be open to learning new ways to make money. It actually should be your sole responsibility as an investor. Since the goal, among other things, I think for most of us here, people say, oh, I invest, I want to be rich. The goal is to create generational wealth. To make sure your family's taken care of and your kids are taken care of. I mean, that's the ultimate goal when you're investing. That's what you want to look at. At least that's what I look at. Maybe that's not the goal for everyone. But for me, it is. For most people I speak to, it is. And you know what? This is a great segue because the guest I'm about to interview is one of the best analysts I know. If you know me, I do not say that often because I think I'm the best analyst. I'm being honest. I'm not arrogant, but I put in the work. I'm competitive as hell. I've been doing this for over 25 years. I take pride in it. I love doing this. I hate when I'm wrong. That's why I cover my losers more than my winners, which my winners far outpace my losers, or I wouldn't be doing this for 25 years. And I'm sure if you ask most analysts, they feel that way as well. Doesn't mean I'm not open to new things. I've checked my ego at the door and learned so many different investment styles. But let's just say you don't hear me say that often when I'm saying this is one of the best analysts I know. So, I mean it. I know this person for 5 years, spoke at conferences together, golfed together, had some fun. But I'm always blown away by his research, which is original, it's contrarian, and it's often right. You're about to get a front seat education to several different investment styles, including international investing, value investing, ETF investing, even cannabis investing, which I know so many of you love. That's just a few, among other things. We're going to cover a lot. So really cool stuff. The analyst's name is Meb Faber, who's the co-founder and chief investment officer of Cambria Investment Management, authored several books and white papers on investing. He's been on Squawk Box, guys, just about every major media outlet out there he's been on. You've seen him. I've seen him just everywhere. Someone I admire because I just really love reading his research. And he also hosts his own podcast called the Meb Faber Show Podcast. I was just building this up. I was doing a good job really building that up until I got to the name of his podcast. They call it the Meb Faber Show Podcast. Is it a show or is it a podcast? I don't know. It's like saying I feel like 100%, 100%. I think he's got to take out the word show there. Like kind of Sean Parker tells Zuckerberg to drop the word or drop the in Facebook. Just drop the the. I think Meb needs to drop. I'm going to talk to him about that. I haven't changed the name of the podcast. Anyway, sorry to get sidetracked, but I love Meb. I built that up so much, and I read his podcast name, the Meb Faber Show Podcast. It's a podcast. His name is popular. Meb Faber Podcast. That's at least what I'm going to call it. But anyway, without further ado, here's my buddy, awesome analyst, really great guy, Meb Faber. Meb Faber, thanks so much for coming back on the podcast.
Great to be here, bud. Thanks for having me.
Well, I want to bring everyone in here, and assuming that people just, we're getting a lot of new listeners to the podcast. And for people who don't know you, which is not a lot of people out there if you're in the investment community, Meb, I know for a long time, incredibly smart, author of several books and white papers. He's an asset manager with a focus on basically all the markets, not just U.S., international as well. And a lot of his decisions are based on data. And the data you're able to find on so many market-related topics, to me, is always amazing. I love reading your stuff because this data usually goes against what most people believe, sometimes what even I believe. So I want to start off with this because you wrote a really good article and published on your blog, mebfaber.com, where you highlight how 80% of the average person's portfolio living in America is in U.S.-based stocks. So not bonds, not gold, not art collectibles, but stocks, and you call this home country bias. So there are people listening to this right now who's saying, thank God that's my asset allocation because the market really kicked ass over the past, since the credit crisis. But when taking a closer look at the data, which you did, it tells a much different story, doesn't it?
Well, here's the thing. So, yes, if you're heavily overweight U.S. stocks, congratulate yourself, pat yourself on the back. Awesome. You've had a massive run the past 10 years. And we're just talking about stocks right now. We're not talking about other assets. So just of the global stock portfolio, most people don't realize that of the world market cap, U.S. is only half. So if you're an index investor, if you go to Vanguard or anywhere else and you go through the global market index, you should only be putting in half. And by the way, U.S. is only about a quarter of world GDP. But most people in the U.S. put about 80% in the U.S. And we call that home country bias. Now, the interesting thing, and Vanguard writes a lot about this, is it happens everywhere. It's not unique to the U.S. If you go to Australia, they put most of their money into Australian stocks. Japanese do the same thing. Canadians do the same thing, although there it's probably all gold miners and cannabis. But my point being is that it's a really, really, really bad idea. And one of the reasons it's a bad idea is just uncompensated concentration. So the same reason most of our listeners wouldn't just put all their money into one stock. Well, why would you arbitrarily put it into one country? And it makes sense to most people because they feel this level of comfort, this false sense of security. They say, I invest in what I know. And often you say, well, do you really know that much to be making that much of an overweight bet? It's usually a pretty bad idea. It's a pretty bad idea right now in the U.S., specifically in 2019, because the U.S. market is expensive. And we don't think it's crazy. It's not like the late 90s, but it's on the expensive side. So to be making this huge overweight bet, we said, first of all, at least be aware of it. But second of all, be aware that the U.S. is quite expensive, which is one of the drawbacks of market cap weighting. So we often tell people to be mindful of it. And the first advice would be to at least get back down to 50% and put half abroad, which, by the way, no one will do.
Why is that? Why will nobody do? Because I've seen you, you've spoken at conferences, and I think 2 or 3 of them that I saw you, because we speak at the same conferences, you start out with saying, hey guys, we're just going to pass around a piece of paper. Let me know what your asset allocation. You say it's funny because it always comes out to like 80% of these people are in US-based stocks. Why is that? Why don't people want to change?
Well, here's a good stat. The last 70 years, if you look at U.S. stock returns versus the rest of the world, the U.S. has outperformed foreign ex-U.S. by about 1% per year. And percent doesn't sound like a whole lot, but you compound over 70 years, and it's a massive, massive amount. And the U.S. has been the darling of the world. And it makes sense because in the post-war period, the U.S. has become the biggest economy in the world, has really been the darling of the 20th century across almost any measure of economics and net worth, et cetera. Now, the problem is, okay, people say, well, Meb, so the U.S. is allowed to be more expensive. We calculate on a long-term P ratio, it's around 30, low 30s, one of the most expensive in the world. Long-term average is around 17. And say, okay, if you believe that it's allowed to be more expensive because it's exceptional, we are, right? Everyone believes they're more exceptional at everything. I'm sure your listeners are brighter, more attractive. But you say, if that's true, what is the historical valuation premium of the U.S. versus the rest of the world? And the answer is 0. And you say, okay, well, if the U.S. has outperformed the last 70 years, how much of that has come since 2009? And the answer is all of it. And so what you've had, this setup, if you look back, and we have a bunch of these on our blog and books and elsewhere, you look at valuation since, say, the 1980s, the U.S. versus the rest of the world, it kind of just oscillates back and forth. There's sometimes the U.S. is more expensive. There's sometimes it's cheaper. Right now, you've had this sort of alligator jaws over the last 10 years where the U.S. stock market has just romped, beaten everything else in the world. But usually that's a 50-50 proposition. And so you have what we called the biggest valuation spread in 40 years, where the U.S. is more expensive. So foreign, the rest of the world is down around low 20s. Emerging markets, which are my favorite, are down around 15 P ratio. If you look at the cheapest detritus at the bottom of the ocean, the really cheap countries, the Russias, Greece, Brazil, which, by the way, are having phenomenal years. I think Greece is up 40%. Russia is up like 30. They're down around a P ratio of 12. And so there's a huge spread right now. But if you go back, it's not always the case. You go back to 2009, everything was trading in low teens P ratio. You go back to the 80s, there was a huge spread, but in the opposite way. The U.S. was cheap, and other countries, particularly Japan, which is the biggest equity bubble we've ever seen, ending in 1990 at a P ratio of almost 100, was a big, huge spread, but it was the other way around. So what we tell people is, say, look, it's hard for the same reason I'm a Broncos fan, for the same reason that other people will cheer for their local team, their local country, state, and it's great to be a patriot, but not with your money. You should be agnostic, asset allocation, asset agnostic over time, and really look to where value is. So long-winded answer to your question, but if you look at it right now, where people are putting 80% in the U.S., which is one of the most expensive in the world, say, look, think about getting back to 50%. And if you're really weird and different and concentrated like I am, you'd actually want to tilt even more towards value, which happens to be towards the rest of the world. And in 2019, we say there's no reason, as we think about the globe, you should really be borderless and sector agnostic. And that's hard to do, which is the main reason that nobody wants to do it.
Well, the most important thing I got from the whole conversation right there was you said it's better to be a Bronco fan, but I'm a Mets fan, so I think that's a little bit worse than a Bronco fan.
Well, really look, I can sympathize with your long-term suffering because I was a Bronco fan growing up when they lost all the Super Bowls. So I was I learned disappointment before they eventually won some. So I can sympathize with long droughts of struggle.
That's great. So listen, you did say something, and also you said some amazing things there that I want to get to, because you said right now, marks or the widest valuation spreads in history of foreign markets trading, at much cheaper levels in the U.S. But the tough question here that I'm going to ask is, this kind of was the same case where it's maybe not in history, but this has been a widespread in 2016, 17, and 18. And doing that, anyone listen to this argument, which, could almost be made back then, put their money into some of these international markets, and, they watch the U.S. really go through. Now, this is in hindsight, right? Everybody's money more to quarterback. But I guess the question I'm asking you is, timing is always the biggest issue here. So why now is the time to do it when it seemed even 2 years ago was a great time to do it, because those spreads were so different and it made sense to just allocate to other areas in the market and diversify?
Yeah, and to be very clear, I would say this exact same thing and have been saying it for the last couple of years, is largely because you don't know when these events happen. They're almost always obvious in retrospect and in hindsight. And you look back and say, oh, that's what happened. That was the catalyst for that event, whatever it may have been. You look back now and say, oh, the global financial crisis was obvious, all these things that led up to it. But the challenge is, over history, if you look back in modeling and you buy expensive countries, you have a much bigger chance of a big fat drawdown in the next 3 to 5 years. And you can look across all countries. The U.S. isn't always the expensive country. Sometimes it's Asia, sometimes it's Latin American countries. In the mid-2000s, everyone was romping, stomping bulls for the BRICS. India and China were trading in the 40s and 60s. And the reason they've had terrible returns since 2007 is because they were really expensive. If you look at the Japan example, they've had horrible returns for decades because it took that long to work off that valuation bubble. So you never know when it's going to be, but the way to think about it is these really expensive markets are just more fragile. Now, let me impress upon one more thing. I said, again, I don't think the U.S. is in a bubble. That's when you get up to a P ratio of the high 30s and 40s and 50s and 60s. The U.S., all the takeaway is that it's going to probably return low single digits going forward. And that's not horrible, but it's certainly not the 8 to 10% people expect. And John Bogle, bless him, before he passed away, said the same thing. He said, I expect U.S. stocks to do low single digits. And so it's more of there's two ways to take away. One is expectations. So if you're going to invest in U.S. stocks and people expect 10%, which is what all the surveys say, I think the most recent one that came out by Schroeder said 10.7% is what people expect their investments to do. That's probably unrealistic, so you should probably take your medicine. But second, if you actually want to try to get higher returns, tilting away from market cap weighting, which historically, by the way, has been a very suboptimal way to invest. And the hard part for the listeners, of course, is they get off listening to this, close the podcast app down, log on to their brokerage, say, oh my gosh, I just listened to this amazing, really brilliant guest, Meb. I need to go buy some Russian stocks. That is probably seen as kind of a crazy thing to do. If you're a broker and an investment advisor and you do that, and a year from now they do well, congratulations, your clients pat you on the back. It does poorly, you get fired. And there's a lot of career risk for looking weird and different. So we don't ever say you need to go buy one country, you need to do anything where you concentrate everything. We just say you need to be mindful about, hey, if you want to look towards value, put probably half in foreign. That's our first step. And then even more would be to put, if you have a value tilt even more towards other countries and other investments. Never go all in on one. Our largest fund invests in the cheapest 12 countries in the world. That way, for every turkey you have, literally, you have Russia and Greece to balance it out.
No, and I'm glad you said that, because you mentioned your fund there. But how could individual investors listening to this, because I know you said, hey, I really like emerging markets earlier. You said it's some of your favorites and you want them diversified. But sometimes it's difficult where, a new investor. And when we say new investors, it doesn't mean, it means, I have a lot of wealthy people in their own businesses, but they just, they don't have the time to focus on the stock market like we do, which is our profession. So how does the average investor go in and look at this? Because if they go on Google, they're going to see a whole bunch of ETFs. They're going to look at fees. They're going to see exposure. They're not going to really they're not going to know what stocks or whatever is in the portfolio, whether if they're good, the weighting. What's the easiest way for them to do and the safest way to really invest if they do want to expand and allocate into international markets?
it's never been a better time to be an investor. We've written a bunch of articles on this where we say, look, to the extent you wanted to buy a global portfolio, not just stocks, bonds, real estate, commodities, and by the way, the global market portfolio, if you just went and bought every asset in the world publicly traded, you get about half stocks and about half bonds, and about half of that is U.S. and about half is foreign. We didn't even get to foreign bonds, but that's the global market portfolio. That's the default index allocation. The good news is you can buy that portfolio for 0.05%. That's 0.05%, which is essentially, once you include, not to go down the huge nerd rabbit hole, a lot of these funds like ETFs or index mutual funds, we vastly prefer ETFs because they're more tax efficient, but you're essentially getting an investment strategy that gives you every security in the world, 20,000 plus securities for free. 5 basis points, which is 0.05%. You include short lending. The fact is that portfolio probably already pays you to own it. So you have a negative expense ratio, and that's awesome. I mean, think back to the days of the 80s when people were paying 2% commissions, 2% management fees, financial advisor fees. You had no shot, right? And now there's never been a better time to be an investor. The challenge is what you just mentioned. There's 10,000 mutual funds and over 2,000 ETFs. The default, we say, is you want to use ETFs because they're more tax efficient than mutual funds. That's a hidden cost if you're a taxable investor of about 0.8% per year. And a lot of people don't know that. So ETFs are the default and low cost is the default. You can forget about the whole active passive debate. Bogle once said, look, the conflict of interest in the industry is not high active versus passive. It's low fee versus high fee. So default to the cheaper funds. Of course, we'd love it if you buy our funds, but I'm really agnostic. Vanguard is one of the best shops, as is Schwab and many others. The whole key is you want international exposure in general, and there's many, many funds that would be perfectly fine. The problem is avoid the really expensive ones, as it's just think about it as like a pole vaulter or high jumper. It just raises the bar for that outperformance you need to have to overcome those fees.
Yeah, and Meb, I know you've interviewed guests. I interviewed guests on your Meb Faber podcast, and you're a modest guy, so I know you're not going to say anything. So I'm going to do it. If people want to find more information on your funds, is it Cambria that they would go to? Because you also have your Meb Faber site, and you also the Meb Faber
Yeah,
podcast.
I mean, my day job, my work job is managing these funds. Cambria funds and Cambria investments, where you can go find more information. You want to hear this monotone drone on for longer? You can find Frank on the other end of the mic on our podcast as well.
Yeah, it was a great time. So that was a couple of weeks ago. But so I want to turn the discussion over to ETFs because there's a lot of negativity out there saying there's so much money in these things. There's a lot of program trading going on. And for me, as someone who's studied the markets 25 years, you see it. I mean, when companies miss earnings, they'll go down, I'm thinking, well, it'll probably pull back 5-7%. And they start off 5-7%, they finish the day down 20%. Same thing on the upside, where you're just seeing so much program trading and just a lot of money flowing into these things. From someone who knows probably more about ETFs than anyone I know, what are your thoughts on this? Because it just seems like whenever anyone out there, if it's CNBC talks about ETFs, they talk about it in a negative way because they're getting too big. But I just wanted to get your sentiments as someone's in this industry who really knows what's going on.
Let's dispel some rumors and misunderstandings. And I'm, as you can tell, very opinionated about some things, and other things I'm not opinionated at all. But on this topic, I am. ETFs are basically like a little speck of sand on the beach of world money. And that may be a little bit of an exaggeration because you're getting anything that has a T after it with trillion, you're starting to get into real money. ETFs are 1/5 the size of mutual funds. So the mutual fund business is still 4, 5, 6 times the size of ETFs. And even then, most wealth that's held around the world in sort of the real money funds over 100 billion, whether it's sovereigns, whether it's large, family offices, everything else is often direct investments. So ETFs, I think most of the criticism is not warranted. One, however, asterisk, star, caveat, anytime you have a fund, this is mutual fund, hedge fund, sovereign fund, ETF, doesn't matter, that there's more money coming in relative to the asset class size. So if you're trading large cap U.S. stocks, you can be moving around 10 billion at a time and not even break a sweat. If you're trading micro cap Brazilian financials and you do that in whatever the wrapper is, the wrapper doesn't matter. you do that in a wrapper where you're moving too much money across too little opportunity set, flows move assets. We all know that. So you put a ton of money, it doesn't matter what it's into. Gold futures, you put enough money into that, it's going to affect it. You put enough money into some microcap stock, Frank recommends some stock trading in a 10 million market cap, you're probably going to move that stock. So ETF is nothing more than a wrapper. Now, it's by far, in my opinion, the best wrapper because it's vastly more tax efficient. But it just sounds to me like it's a media darling for, the same way that people are complaining at length about buybacks. It's something that I don't think has a lot of merit, but there are times when it could be an influence on markets and move markets around. But remember, the big guns are not in the ETF world. It's mutual funds and the bigger sovereigns that are moving it exponentially more assets than ETFs have.
No, thanks. And I love asking that question because you hear so much stuff out there. I'm sure you see so much stuff, even when it comes to the earnings side and I see people talk about different things. I'm like, come on, it's like, that's what Twitter's for, to just go in there, but, and really go crazy.
There's a great, not to interrupt you, but there's a great chart that shows the annual revenue by investment vehicle, and ETFs and index mutual funds are just minuscule because they have lower fees. But if you look at active mutual funds and hedge funds, it's like over $200 billion in fees because they're much higher. The average mutual fund is 1.25%. The average ETF is half of that, but hedge funds are 2 and 20. But you got to remember is who supports that ecosystem of all the remoras around the shark, where those funds being super active generate a ton of fees of trading and everything else to the ecosystem. So they're supported. But going back to our friend Bezos, he says, your profit margin's my opportunity. And if you look at the asset management industry, one of the highest profit margin industries in the world, of 150 industries, that is a area that, in my opinion, is going to change. So you will see more flows into ETFs, and some of the weird ones may see some distortions in markets, but that's the way markets have always been for hundreds of years, I think.
Yeah, it definitely makes sense. So I want to get to the research part, which I love picking your mind at, right? Since we both do a lot of research. And, I mentioned earlier you authored several books, several white papers. If you go to Meb's blog, pretty amazing. I mean, it's just the data that you put out there is awesome through the research. And we're all told, right? Because a lot of this research, what we do is we can't compare it to, historical, right? Because we're told, at least through many of the most popular investment books that we've read over our lifetime, that history repeats itself. And of course, that's true to some extent. But today, we have a Fed that seems like it's not really operating alone. Okay, I don't want to get into the political aspect of it, but just the way that they turned so quickly, where it went from tightening to easing, was pretty remarkable. Following, the current administration's lead. We also have a Fed that lowered interest rates to levels this country has never seen in its history. We have a Fed that is intent on keeping rates low for a very, very long time, and also a government that was willing to hand consumers checks to buy cars and houses, as well as take stakes in our banks and numerous companies during a credit crisis, which does make these times different and unique. So my question to you is, do you factor in some of this in your research when using, say, comparative analysis with different markets, especially maybe when you're valuing U.S.-based stocks with the rest of the world who, don't have a printing press on call to print money whenever there's, any hint of any risk or problems in the world?
A lot of good wrapped in there, Frank. The first part is, I think it's instructive and important for any investor to try to be a student of history. Obviously we're on the younger side versus a lot of the old gray hairs, no hairs that have been investing for decades. So the way to combat that experience is to become a student and look at what's happened in markets over the past 150 plus years, even further than that. And I know you do too. One of my favorite books is Triumph of the Optimist, that looks at returns of equities, bonds, and bills and inflation in dozens of markets around the world back to 1900. And listeners, you can get a free version of this book called the Global Investment Returns Yearbook that Credit Suisse puts out every year. So the challenge is that you look back in history and almost everything has happened. You've had markets go completely to zero in China and Russia. You've had, even in markets that have been the best performing stock market in the world, the U.S., decline over 80% in the Great Depression. You've had markets where, for the first time in history, they always surprise you, right? 2017, the first time the U.S. stocks went up for every single month in a calendar year.
Yeah.
They're always surprised with something new happening. And if you look at the macro environment, taking the macro data and, I would say, discretionary or subjectively coming up with an investing strategy is really, really hard, which is why our quants over here. So we try to come up with rules that have worked, hopefully not just recently, but for the past 100 plus years as well. We try to find academic and practitioner research that supports it where it's worked for decades. So the two biggest pillars we use are value, so trying to buy cheap stuff or not buy expensive stuff, and momentum and trend. And so trying to buy things that are going up and not trying to buy things that are going down. Both of those have been around since the early 20th century, back to the time of Charles Dow and Ben Graham had been writing about it. Slightly different interpretation and implementation. So as you look around the world today, despite all the geopolitical stress, and I think if I just listen to geopolitical news, all I would do is buy puts all day long. It would be my only investing strategy. An asset there's ways to protect yourself. The first thing is you have an asset allocation strategy that should perform well in any market environment. Even if it's buy and hold, should do just fine. But on top of that, try to have some tilts that help you out. And the two big ones for me are value and momentum and trend. And, I implement that in a rules-based systematic way that hopefully should be able to take into account any market environment or regime that's going on in the world, whether it's inflation, disinflation, whether it's cheap markets, expensive markets. And I still read the news. I'll gossip with you over a beer if we're hanging out. But we try to listen to as little of it as possible and make its way into the portfolios, because that's really where the emotions creep in. And when the emotions creep in, as we know, that's when people start making really, really dumb decisions.
Yeah, and for everyone out there, we've been doing this for a long time, and I know I get emotional sometimes. I mean, it's hard not to be totally emotional, and people say, well, take the emotions out of it, but sometimes you do get a little bit emotional, but it's good to just, kind of step back, because that could hurt you. And also, we're just programmed to buy things when they're exciting and then to sell things when everybody hates them, when it's the opposite when it comes to investing, right? So it's just kind of weird when you program sentiment into everything, I guess. But I want to talk about just more into the ETFs, because when I look at Cambria, you guys have a whole bunch of offerings. We talk about international ETFs and so many things. But right before we started, you said something interesting, because you were going to launch a brand new cannabis ETF, right? Which is a big industry people love right now. But there's a couple of things that seems like, get really exciting on your front, but you're planning to launch this pretty soon, aren't you?
So as you look around the landscape of funds, we only launch funds that we think, of the thousands of funds out there, do we really need tens of thousands of funds? We say we only launch funds that I want to invest my own money into. And it's a surprising fact, but it is a fact. Morningstar reports this. The majority of mutual fund managers invest $0 in their own fund. So not 100,000 or a million or 10 million, $0. In some cases, it's up to 80% in some categories, where the manager has nothing invested in their own fund. So I invest all my public assets into our funds, and the vast majority of them in one fund. And so I just want to lay it out there that I think it's important to have skin in the game. But we only launch funds we want to invest in. Otherwise, if Vanguard does it better, I'll just go buy a Vanguard fund. So it has to be based on some sort of academic practitioner research. We have to think we have some sort of edge, or else we just won't do it. And then lastly, of course, is it better or cheaper than what's out there? And cheaper is harder these days, because we're competing with these firms that have trillions of assets like Vanguard, but in some cases it does still happen. And historically, we've shied away from the thematic space. But cannabis is an interesting use case in that it's a industry that already exists and has very wide adoption, not just in the U.S., but globally in many different forms. So we're not just talking about marijuana and the usage of people smoking it, but we're talking about hemp production. We're talking about CBD. And you have a somewhat black market illicit demand that very quickly over the past few decades is becoming mainstream. And so, often in the thematic world, you have industries that are being created from scratch, whether it's, the Internet of Things or some 3D printing, which was hot, and people chase these and they put a bunch of money in them and they sort of fade away. This is somewhat different in my mind because the industry that's been around for a long time already. And we're going back to the earlier conversations, most investment funds in the ETF space are market cap weighted indexes. And the problem with market cap weighted index for listeners out there is because back in the 1970s, it was a massive innovation. But the reason it was a massive innovation was not the actual index. It was the fact that the index, being market cap weighted, meant you don't do anything. You just buy the largest stocks and move on, which allows you to have very little turnover, very little cost. And because you're not doing anything, you can offer it for a very low fee. So the Vanguard Wells Fargo innovation in the 1970s of the birth of the index fund, the real innovation was low cost. So the problem with market cap weighted funds is there's no tether to value. So often the largest stocks get to be the most expensive, and that's true in the U.S. right now. And it's always true where the largest stock in the stock market at the time it's the biggest goes on to underperform the market by about 3 percentage points per year over the next decade. Same is true with sectors, same is true with countries. You want a good investing strategy, all you have to do is avoid the largest stock in each sector, country, or index because there's no tether to value. It gets to be the biggest because of price appreciation. So as you look about in the cannabis space, we think it's a really interesting opportunity to invest in a rapidly growing industry, one that is getting into the tens of billions of dollars of revenue already and is only going to go, we think, exponential from here. And on top of that, it makes sense not to market cap weight index it. Otherwise, you're going to have scenarios where you just end up with a lot of these companies where there has to be a fair amount of speculation. And the big problem we talked about earlier with investing in global markets is trying to avoid buying companies that are really expensive, which market cap often does. So it's not a market cap weighted index, but we do think there's a lot of opportunity and should be fun. And again, the caveat, if you listen to me over the past number of years, you would know this would be a very, very small part of your portfolio. The big muscle movement should be, the large asset classes. And this would really be something that would be a thematic smaller portion, but we think it will be interesting.
Yeah, and this seems like, the fun part of portfolio, super high growth, lots of risk, which is going to bring me to something which I found interesting when I was doing a little research on you. And the fact that you, after college, you worked in Washington as a biotech equity analyst, and you have a double major in engineering science biology. You get in the cannabis sector. The biotech industry is a lot of fun. It's crazy. It's nuts. Do you still follow that? Is that something that you're into? Because going from biotech into money management field and quant and stuff like that seems like a big leap. But biotech is a pretty cool industry if you have the right context and invest right. Yeah.
I graduated in the year 2000, which was a really exciting time. That was the original bubble for us, the late 90s internet bubble. Such a fun bubble. I mean, there's a lot of echoes today with a lot of what's going on in the world, but it was also a dual bubble, if you remember, because biotech stocks were also in a bubble. The human genome was getting sequenced. Really exciting time in the biotech world. I was ready to go back for a PhD. I took a year off to work as a biotech equity analyst while going to grad school at Hopkins. I was working for a fund that did biotech investing. And this is what actually really started to drive me to be more of a quant, because biotech investing is the ultimate binary outcomes. You have some of these stocks that get approval, they don't. You know this, you've been in the small cap world for forever. They're either going to go up 200% or they're going to go down 90. And it's the ultimate binary events. And so I spent a lot of time trying to quantify an area that's pretty hard to quantify, but really over the years, that's what drove me away from really discretionary investing more towards quantitative. And at this point, biotech has become more of a hobby. I certainly follow along. I think it's fascinating. I've gone through all the ancestries and everything else and love to keep in the loop, but really I think it's most important on my side as for most investors, to automate their investing, try to have it on autopilot so you're not mucking around with it. You could have a little fun play account, but I keep an eye on biotech, but not actively involved on a day-to-day basis. But you are seeing, as you mentioned, some interesting overlap going on between the cannabis and biopharmaceutical space as well.
Yeah, no, absolutely. And last thing here, I know you love skiing and surfing. Is there any chance we can get back on the golf course again? Since, we talked about this and mentioned it sometimes. The last time I think it was because of me, maybe I had a couple of years, but it was actually the first hole. It was on a hill and I forgot to put the brake on. The cart just started going and you kind of saved me from a lot of probably expenses and stuff like that. But what about golf? Are you still going to get back on the golf course or did you give it up yet?
I will play and I will love to hack around. For me, it's like weddings and any other social events. I'll get out there. They're opening a Topgolf right next to my office, so that might be my my practice range for a while. But I'd love to play. I'll do anything. You come out here, we'll get you on a surfboard. We meet up in Colorado or Vancouver. We'll shine the skis up too. I'm game.
Nah, it sounds like a plan. So last thing here, if someone wants to learn more about you, and please give Twitter as well, because I love that you do surveys on there and so many people respond. You have a very big following in your blog. But if people want to learn more, read some more stuff that you're writing, how can they do that, Meb?
If you want to watch me pick fights, then Twitter is the best place at Meb Faber. If you want to read the blog posts and follow the podcast, then it's just mebfaber.com. And if you want to see what we're doing at my day job, then it's all the Cambria sites, Cambria Funds and Cambria Investments.
All right, Meb, thanks so much for coming on. Listen, open invitation for you whenever you want. Love talking to you. I know my audience loves you. I've been following you for years. Love your stuff. And I really appreciate you taking the time to come on, buddy.
It's been a blast, bud. To see you in Los Angeles. Come say hello.
All right, you got it, man. I'll talk to you soon.
Bye.
Man, I could talk to Meb for hours. In fact, I was on his podcast. He mentioned that a few weeks ago, and he did a full hour interview. I think it was even longer than an hour. And we covered so many different topics, so many different sectors. Just awesome. But I love talking to him. And the one thing you realize about him is he would do this for free if he didn't make money. I mean, the passion, how much he loves it, how he really digs into the numbers. He takes pride in that. And, he's a good guy. He's someone, if we did have a conference, he'd speak out in a heartbeat. He's just, as great as an analyst he is, he's even a better guy. But, again, I do these interviews for you. I try to get the best analysts in front of you, guys that I vet, that really do the work, that I trust. But this podcast is about you, not about me. I mean, so I want to let you, let me know what you thought. FrankCurzioResearch.com. That's FrankCurzioResearch.com. Again, I love that interview. I love picking his mind. I love learning about new strategies and different things. But, I want to get your feedback. Again, this podcast is about you. So be sure to send me emails, questions, and comments, especially in the interview it's Frank at CurzioResearch.com. So sorry the interview went a little long, ran a little late, but I did want to provide an education segment for you. And I was going to ask you guys to do some homework for me. Well, homework for yourselves. It's not like you have to send it to me and if you want, send it to my email or whatever. Hopefully we'll get a couple. If not, don't worry about it. But here's the project. Because I know so many of you are familiar with Micron, right? Produces DRAM, flash memory, USB drives, flash drives. Very, very, very popular company, right? I don't think, if you're an investor, most people have heard of Micron. And what's crazy about this stock that I don't see with other stocks is the coverage from Wall Street is all over the place. And usually when you see a big company like this, which is a $45 billion market cap, revenue streams are going to go up and down. It's a cyclical company. Most of the analyst estimates are, I wouldn't say, they're not the same, right? I mean, of course, it's more aggressive if the analyst is bullish, more conservative if the analyst is bearish. But it's never like outside of Tesla, which, you have diehards and the people who hate it. But, you don't see a stock that's trading at 40 where you got price targets at 20 and price targets at 90. You really don't see that. And I cover, if not thousands of these stocks. You don't see that. You don't see, IBM is 140. You'll see 175, $200 price targets and maybe, 130, which you don't see like, 85 and 300, which is all over the place, especially when you have so many analysts covering that particular stock. And by analysts, I mean the sell side, the Citigroups, the JP Morgans, Goldman Sachs, Morgan Stanley's. So I look at Micron, it's trading at $43, and the stock fell from 50 to 35, and this is, the 12 months from July last year through June, and surged back over $40, mostly because it's a big supplier to Huawei, which Trump blacklisted as, a company the U.S. won't do business with, and that crushed the stock because you have 13% of sales from Micron that are accounted from that one company. Now he changed his mind. The stock rebounded, right, which we see all the time with this president. Just back and forth. Who knows what's going on, and which is fine. Again, politics aside, I'm just letting you know how it is. You don't know. It's just if you look at Micron and you look at the last 3 to 4 months, and that whole thing, it was driven by Yahweh. And that news flow. Now look at the buy, sell, hold recommendations for Micron. 20 firms have a buy rating on it. 20. 12 have a hold, and 4 firms have a sell. So look at all those analysts, right? Tons of them. 30 analysts. The entire world covers a stock. Everybody knows everything about it. You're not really going to find anything that you don't know about it because, again, it just has so much coverage and it's out there. It's talked about all the time. The CNBC and all the media outlets and stuff like that. Now, when I go into the price targets, right? So that might not sound too crazy. 20 buys, 12 holds, 4 sells. Okay, yeah, that's not too crazy. But listen to some of the price targets. Wedbush has a $30 price target. Stock's 43, and they have a neutral rating. A neutral rating, $30 target with that much downside. I mean, if you have more than 10% downside, you should have a sell rating. And you're looking at 25+% decline, and you're looking at a neutral rating, a $30 target. RBC has a $50 target. Citi has a sell rating, $30 target. Credit Suisse has a $90 target, so more than a double from here. Robert Baird, a boutique firm, $21 price target, a more than 50% decline from here. Morgan Stanley, $32 price target, again, big firm. And it's all over the place. So as an investor, you're going, wait, I don't understand. I mean, do I like the stock? Do I don't like the stock? If you want to look at sentiment, is sentiment positive? You can't really tell. Everyone's all over the place. People hate it. People like it. You just really don't see that much of discrepancy, especially in price targets. And when you factor in everyone's crazy targets, all these guys, you come up with the average of $43 where the stock's trading today, which is kind of interesting. To make matters worse, you look at the funds. I mean, Appaloosa has a monster position in the stock, but started selling shares last quarter. Again, I think it was like 2 quarters ago. Again, Yahweh news and stuff like that. Omega Advisors closed their full position. I think it was last quarter, the quarter before. Soros closed his position as well. Fidelity increased its stake last quarter. Wellington increased its stake by over 60% last quarter, close to $900 million position in the stock. So again, when you're looking at funds and trying to gauge how people fit, everyone's all over the place. Now, say if you're looking at Micron, I'm getting to my point here, and you do the research and say, you know what, I really like this stock. I think it's a buy. Before you ever buy a stock, that whole entire research process, after you're done, before you buy it, you've done your research, you like the stock, there's one thing that you need to do. Look at its competitors. Because you could be right on Micron. And Micron might go up, say, 15, 20% over the next 12 months. But a stock inside that sector, and again, you're investing in a sector you think is going to go higher, but you could find one of its competitors that could go up 200% over the next 12 months. And you're not really going to notice too, but that's a huge, people associate losses where if you're losing money, when in fact you are losing money because instead of getting a 25% gain, and you're probably happy and you didn't really do that, it's called comp analysis. We compare it against the industry. I mean, you might find a stock that's cheaper, growing more, and then you start looking, insiders are buying, and a couple of big hedge funds bought. But it was just off your radar because Micron is covered by the entire world, so everybody knows what's going on. And you're like, wow, this company's in a much better position. They don't have exposure to Yahweh, which who knows which way, depending on how the president wakes up, that news is going to flow. And it's moving this stock 15, 20%, depending on if he says we're in good standing or they're still blacklisted. So you remove that risk. When I look at Micron before, I would buy something like that right now, today's price, you may want to look at Intel. I know stock has fallen after breaking through the $55 level. If the management said expects to grow into the low mid-single digits over the next 3 years. So it did pull back on that news, but they're into a lot of growth markets. And when I look at Micron, which is up huge over the past month as it recovered those losses through the Yahweh, its stock's now trading at 17 times forward earnings. Sentiment was super negative last month. Now it's really positive. They just reported decent results last quarter, and the stock's up sharply. So now you're looking at a stock where expectations are high, and it's trading at an average market multiple, the S&P 500 17 times, yet they have lots of headwinds. And DRAM and NAND prices are falling. They're falling hard. You 13% of sales related to Yahweh. Again, it's still a risk depending on, that political risk. I just went over that. And China negotiations, whatever. But this is a company that you're seeing where earnings are going to decline year over year. Sales are going to decline year over year. But yet it's trading at a market multiple where the average company S&P is expected to see, I think it's about 3-4% growth in sales over the next 12 months and about 5% to 6% growth in earnings. So you're probably better off buying the S&P 500. Plus, Micron doesn't even pay a dividend. But when I look at Intel, it just tells a much better story. And again, it's comparable analysis, not that Intel's a direct competitor to Micron, but they're both pretty much in the same industry. When you do this type of research, that original, maybe, again, Micron goes up even 50% over the next 12 months. But if there's a competitor or whatever that goes up 100%, that's money you left on the table because you just didn't take that extra step to research and compare it against the rest of the industry. And that's what I learned because those returns are huge. I mean, I see it happen so many times where people tell me, oh, man, I had Amazon, I sold out. I had Tesla at 45, 50. Oh, man, I sold out. I know someone who invested in Canopy Growth and its early stage financing and sold it at like 7 or something or 6 or whatever they sold it at, which seemed like a great trade at the time and they made a lot, but look where Canopy Growth went. And you're leaving those gains on the table. And people say, well, I have a 5x gain, but now you could have a 300x gain in your own boat in your house. By just going the extra step and looking at the industry, you may find hidden gems. I mean, you might be right in the industry, you might be right in the stock, but it doesn't mean it's the best play within that sector. Because when I look at Intel and compare it to Micron, again, no dividends, 70 times forward earnings expected to decline year over year, sales expected to decline year over year. I mean, Intel, there's super low expectations. Nobody really likes it here. So any positive results in their quarter is going to result probably in a 5% plus pop to the upside, while weak results are kind of likely priced in. So risk reward's favorable. It's trading at 11 times forward earnings. 11 times forward earnings, solid balance sheet, which Micron has a solid balance sheet as well. But Intel's going to pay 2.6% yield, which is much, much higher than the S&P 500 when Micron doesn't even pay a dividend. So for me, right now, if you do the homework and you're looking at these two stocks and you really like Micron, for me, I think Intel's a much better play. But I see so many people talking about Micron, saying, why would you buy Micron when you could buy Intel that's growing faster than them, that's much cheaper, has a good balance sheet in a lot of these growth markets? Of course, watch Micron get taken over next week. I look like an idiot. But I'm just saying, barring anything crazy like that, and I don't know why anyone would, at a very expensive valuation now that it's come back and roared back from the 30s into 43, 44. And whether you agree with this segment or not, and not whether you agree with this segment or not, but mostly if you agree with, hey, I like Micron and Frank, Intel's the dog or whatever you say, whatever, that's fine. But the concept, trust me, please pay attention to the lesson here, because after you do your research and after you say, wow, this company looks great, I love it, everything checks all the boxes that I look for, no matter what investment style you use, all the stuff that I covered early in the intro, before you actually pull the trigger and buy it, just check out. Do like 10 minutes, 15, 20 minutes of research on like 3-4 other companies. Just see where they're trading, see how they're growing really quick. And if anything like triggers and say, wow, insiders are buying this name, why are they buying it? Go back, look at the chart, see what happened. Is it down a lot, or if it's something that's a temporary thing? Maybe they missed sales or estimates, or they had delayed contracts that they're going to see in the second half of the year. And today's market with algos, you missed a quarter. Nobody cares why. They just go down 10, 15%. You'll see those companies jump right back up after the quarter. So it's important. Do your homework on this. When I say do the homework, if you want to send me analysis on why would you buy Micron over Intel, I'm all ears, because I don't know why you would. Again, buying Intel over Micron right now at these prices. Okay, not last month, not 6 months ago, right now, today, Intel to me seems a great buy. But hey, if you do the research, you want to do that homework that I just asked, send me an email, frankcurzio@research.com. I promise I will respond to you as fast as I can. It's busy these days and it's crazy. But I want to hear why you would buy Micron instead of Intel here. I'm very interested. Maybe you come up with good points. For me, I just don't see it based on growth, based on value, based on long-term growth potential. And that's how I do my research, where it's not just, hey, this is a stock, it's cemented in stone. No, the last step should be, let me just compare it. Let me look at the competitors, because you might find a better idea. Whew. All right. So we covered a lot today, all kinds of analysis, Great guest in Meb Faber. Also, went over comparative analysis, how it's really important for your portfolio, how you can increase your returns. So I really hope you enjoyed the show. Any questions, comments, feel free to email me anytime, frank@curzioresearch.com. That's frank@curzioresearch.com. Remember, I'm here for you. So guys, thanks so much for listening. And I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.